Hello. This video is a follow-up to the episode 1 order book and candlestick anatomy video I did a couple of days ago. But in this episode 2, we are going to tackle all the problems with candlestick patterns. If you are new to this channel, you will learn how to make nice entries with candlestick patterns like the engulfing candle, for example. You are going to learn the context following them. Remember that candlestick patterns, where and whenever they form, have to be used alone. They are used with other confluences like resistance, the fair value gap, or other block for them to have the needed strength. You are welcome to my channel. This is OTF Capital. What I'm about to give you in this video is a piece of information that will turn all your confusions into something you can understand, to turn your chaos into a curriculum. This video will give you an insight to when big money enters the market. You will know and see it. I didn't just create a video, I created an insight, a piece of information that when it compounds will give you clarity to every price action you see in the market. 99% of traders, I'm talking of the beginners, those in a paid premium groups and even some gurus, they still fail in their trade setups because they skipped the knowledge of candlestick patterns, especially because they underestimated the power that they have on the chart during price action. I found out that someone will collect money from you, out you in a paid premium group, but when you don't improve in a month or two, you begin to ask questions, where am I getting it all wrong, even with all the fantastic strategies? It is because you chose the shortcut to make money fast and become a millionaire, forgetting that a video about candlestick patterns you skipped some time in the past will still come back to haunt you in the future. If you are seeing this video for the first time, it is such a privilege. If you are a beginner who doesn't know what is your momentum and where it actually began from, where it actually started to build up from, this candlestick video is for you. Knowing how to read candlesticks will help you to understand the market, especially candlestick patterns. I am going to show you an entry example that was taken using engulfing candle pattern. This is quite an interesting entry for you to consider whenever you want to make your entries. Of course, after learning this from this video, I think you can be applying them and you will stay profitable when you apply them and use them correctly. Knowing how to read candlesticks will help you to understand the market. You will take more accurate entries. Let's take, for instance, this engulfing candlestick pattern that formed here. You will see a green bullish candle form first, followed by a candle that completely took control of it. The candle that engulfed it will be a bearish candle. Whenever you see such a formation, just know that it is a bearish engulfing candle pattern. And I've always mentioned in my previous video that you don't take entries using an engulfing candle pattern or other candlestick patterns alone. You don't take entries from them alone. You have to add confluences. You have to find a confluence that aligned together with the candlestick pattern. And I can see a confluence that aligned with it. One of the confluences that aligned with it there is a bearish one-day fair value gap. Just look at how this one-day fair value gap aligned correctly with the engulfing stick pattern. Let me zoom it here. Of course, it's staying inside the fair value gap. You do not take candlestick patterns entries alone. You must make sure that they align with a confluence, support and resistance, fair value gap, or an order block, as I mentioned at the beginning of this video. Then how do you take an entry from the engulfing candle pattern? You will take an entry at the closing price of the red candle that engulfed the green candle. How does a bearish candle form? A bearish candle forms when the closing price is lower than the opening price. The closing price closed below and the open price opened above it. At what price did it close? It closed at 103k. As soon as the candle is closing, whenever you want to take an entry out of a engulfing candle pattern, the bearish engulfing candle pattern, you take an entry at the closure and make sure it is aligning with another confluence, fair value gap, other block and resistance. So in this very scenario, it's aligned with what? In the 1 day bearish fair value gap. So this is where we take our entry and put our stop loss at the high of the red candle and target 4 hour where your greed can carry you. That's where you're going to target your take profit there. So at the end of the day, we ride with the price. Knowing how to read candlestick will help you to understand the market, especially out of a bearish engulfing candle pattern. You take more accurate entries, easily avoid many losses that you would have taken, and ultimately it will help you to stay on the right side of the market. This is one of the parts of entries traders use in executing their buy and sell setups. For me personally, I don't use them alone. They are all incorporated into my trading model, which I am going to talk about in my future videos to come. So try and learn this once and for all. Whenever you see an engulfing stick pattern, an engulfing candle pattern, do not take an entry from them alone. Try to find a confluence it's aligned with. So this should give you an idea that the more confluence is present at a particular region, the more confluence is present there. Maybe you can as well find a resistance here. The more confluence is present at this particular region or this area of interest, the stronger your entry. There are other candlestick patterns too. We have the morning star, the 3 white soldiers, the bullish engulfing. So all these are the bullish patterns, which you can always find at every bullish price movement. So we have the Tweezer bottom, the bullish pyramid. So on the bearish side, we have the evening star, the 3 black crows. So it is the opposite of the 3 white soldiers. So we have the 3 black crows. We have the bearish engulfing. The one we just use in a chart for an entry is the bearish engulfing candle. So we also have the Tweezer top. After the bullish Tweezer bottom, we have the bearish Tweezer top, and we have the bearish pyramid. So all these are patterns that you should know and master. So whenever you see them, you can't use them alone. You cannot use all these bearish and bullish patterns alone. They have to align with with other confluences for them to have the strength, the much needed strength to push either higher or lower. So as you can see, the one we just used as an example is a bearish engulfing candle pattern. So this is it. So this is where it formed. So this is where it actually forms. So this is where we use it in our example. Coupled with what? Another confluence. What is the confluence? 1 day bearish fair value gap. So mastering this like this will help you to have an edge in the market. Remember, this is not my trading model. It's not my strategy, but I incorporate this concept in my strategy for me to have a much stronger edge when executing my trades. We have to understand that it is important not to only memorize the names of candles itself. It is also important to understand how the candle is created, and that is true edge in understanding how to learn candlesticks. We have 2 types of candles generally. The single candle. I will explain to you what one individual candle means. We also have multi-candles that come together to create a narrative, to create a story that we can respond to in real time. Multi-candles can tell you a story and can also help you understand movement in the upward or downward direction quite fast, regardless of the type of trader that you are. Swing trading, intraday trading, or scalping. There are a few pieces of context that I would like to go into. I won't go much into details because this is exclusively a video about candlesticks, but there are 3 important pieces of context that you need when looking at candles. As I mentioned each of the candlesticks, I will mention these terms. Number 1 term among them there is support and resistance. Just remember that any candle you find within the support and resistance, they don't have much significance compared to the ones you will see moving out of the support and resistance areas. Okay, just know this, but I'm going to show you everything in the example in the chart here. Support and resistance are levels where buying and selling are the strongest. In this kind of price movement, where you see price moving up, moving up significantly. As it got to a point, as you can see, this is an upward movement, it's an uptrend. As it got to this point, it got resisted by much selling power from the sellers. So as it got resisted, they start pushing the price lower. So as it got to a point, maybe at any fair value gap or other block or even swing low, price found a support there. And as price is pulling away from the support, going back to the resistance, this resistance will now act as what? As a ceiling. Then the support will act as what? As a floor. So these 2 points will hold price. Price cannot easily pass through them. It will hold price for a very long time. Whenever you see a price action getting stuck up in a box, that's what we call ranging market, sideways market. As you can see how it is moving, it can also be called consolidation. This is how it is going to be consolidating until a certain period of time. The support here is what? It's an area where there is a large amount of buyers. There are so many buyers here, and they are strongly doing what? Defending the price. So this is a point where sellers are exhausted too. When price pushed up here, we got resisted. Sellers have to push the price lower. So as they get to this support area, they got exhausted. Of course, this is what happened here. They got exhausted at this area. So you can see there are multiple churches there. Buyers are here constantly defending the price. And the resistance, this is the top level where sellers step in to defend the price and cause reversals on the price. Sellers are here defending the price, and they were constantly causing reversals. They were pushing the price lower. Each time price got pushed to the upside, the sellers push it lower. This is how they were constantly defending the price until a certain period of time when they were what? Exhausted. Either the buyers are going to be exhausted or the sellers are going to be exhausted, and price will now break out of either the support or resistance. That is when you will know the sides that are pushing price significantly way lower or way higher than the other participant. The candlesticks that form within this area are very, very important, because they will signal to you what is happening, whether it is a reversal sign or a breakout of one of these levels, like we see them on the chart. I'm going to show you a perfect example of how price consolidates in what we call a ranging market or a sideways market. So after a certain period of time, when price must have consolidated around the support and resistance zone, one of the participants must surely do what? Break out of either the support or resistance areas. So at this point, the people that broke out of the area is what? The sellers. So when sellers broke down below the support, that support is going to act as our resistance. And for you as a smart trader, for someone who is smart enough, this is where you're going to do what? Take your entry. And for your information, support and resistance are areas that can form a confluence to what? A price action. This is exactly the areas where you'll be looking for the formation of either the bearish engulfing candle, or the 3 black crowns, or the evening star, or even the tweezer top. These are areas where you're looking for them. As price broke down below the support, at the formation there, be watching out for the type of candle that will form here, whether it's the bearish engulfing candle or the bearish tweezer top. This is how you can take advantage of the market using the candlestick patterns as an example. Let's dive into the chart. Let me show you an example how it is played out perfectly. Right everywhere on the chart you can find support and resistance. If you train your eyes well, this is an ranging market because it is consolidating. Price is not moving up fast. As you can see there, price is not doing what? Moving up fast, and it's not moving down fast. So it's only consolidating within a range. So this range is what we call the 2 points of the ranges is what we call the resistance and the support. So it will continue ranging until one participant, either the seller or the buyer. So at this point, the seller will be the one that pushes the price lower below the support. How can you take an entry from this kind of price action? Immediately we saw that breaking below the support right at the closure of that candle, we might see a retest of that support, because anytime the support is broken, it returns to resistance. But at this point, we didn't get a retest, so we didn't get a pullback. So at this point, what you're going to do is to enter directly from the closure of the candle that broke out of the support, or you wait for your candle formation. So as you can see here, I can see a candle formation there, which is an engulfing candle pattern. So this is it. This is the engulfing candle. This is the engulfing candle. You take an entry at the closing price of the red candle. Put your stop loss at the high. So for me, I can target trade to reward ratio. So this is exactly how to trade your support and resistance. So there were areas too where you can find support and resistance, like this area, this zone. We can also find some support and resistance here. This is our resistance because price touched it a couple of times. About how many touches? 1, 2, 3, about up to 6, 5 to 6 touches. What the price did there? Price was ranging. As they were ranging, the sellers had to overpower the buyers and push the price below the support. So this is a perfect price action that I like to see. Whenever you see this kind of price action, it is very, 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 very crucial. So at this point, as you can see, as price broke down the support, we had to retest. So this is a perfect price action that I like to see. So on the retest, you can take your entry on the retest there, right below the support area, and put your stop loss at the swing high, the last swing high. This is the swing high. This is the last swing, the swing point that formed. So this is the last swing that formed. This is where you're going to put your stop loss and target what? Where your greed can carry you. So here I can target 3 RR and get out of the market, or I can target 4 RR. Even if the price action can lead you to targeting 5R, lucky for you, congratulations. Another form of entry is for you to wait for your candle pattern to form. In this case, we can also see a bearish engulfing pattern. So this is a very beautiful price action. So for you to, of course, patience is required when you are in the market. So for me, if I don't want to enter directly on the retest, I can wait for my candle formation. I can wait for my bearish engulfing candle to form, or I can wait for evening star, or the bearish Herami, or the Tweezer top. As soon as it forms, I put my entry below the bearish red candle, put my stop loss above the high of the red candle, and target what? The same 3RR or 4RR. Target your take profit and get out of the market. So this is exactly how to do what? How to trade support and resistance. Next on the list is a concept of a catalyst. A catalyst is the news of some events that causes sentiment to change by price movement on a particular forex pair or a crypto pair. Remember that news events can cause more drastic change to crypto, especially Bitcoin. We are already on a Bitcoin chart. You must have seen Bitcoin falling sharply where there is a war news, earthquake, or United States election. Even from the recent US and Israel strike on Iran, Bitcoin reacted on the news. Catalyst generally causes an imbalance in price that is obvious, which will allow us to catch the momentum. Pay attention to this. Candlestick that form after a news event, those candles are very, very important, and they will help us to understand how dedicated buyers and sellers are to that particular move following the news. So let's check on these Bitcoin price actions on a candle that formed on the announcement of US election in November 2024. Let us trace back to November 2024, exactly when the US held on the date when the US held their last election. America held their last election on 5th November 2024. Before the United States election, there were price consolidation, long period of what? Price consolidation. Like I showed you here, maybe I didn't show you how a resistance usually break out. Maybe we can see, for instance, for this previous example, Remember, price broke out below the support. There are other price scenarios where you can see a breakout out of the what? Out of the resistance. Whenever you see a breakout there, on the retest of that resistance, because whenever a price break out of resistance, that resistance returns to support. That support is where you're going to do what? Take your entry. That resistance turns support is where you're going to take your entry and find a swing low to put your stop loss and target what? 3 risk to reward ratio or 4 risk to reward ratio. This is exactly what happened on the election. There were a long period of price consolidation. Whenever you see price ranging on what we call a ranging market, price action there were no liquidity that is injected in the market right at that particular point in time. The market lacked what? The market lacked liquidity. There is no volatility pushing the market up, no news catalyst pushing the market up, pushing the price up. So as you can see here, there were months of what? Let's check the days. There were how many days of price consolidation? Almost 252 days of price consolidation. This is February to November. After a period of long price consolidation, as you can see, price we are rejecting. There were multiple touches on the resistance zone, even on support area, to show you that either the buyers or the sellers are in control. There were quite a number of price rejections. So how many touches do we have there? Quite a number of touches on the resistance zone. We have up to what? Up to 6 touches there. So this is to remind you that sellers are constantly defending the price here and pushing the price lower. Even when price got to the support area, the same thing happened. We are in a consolidating market, sideways market or ranging market. Now coming to what happened on election night. This particular bullish candle formed on election night. So this bullish candle formed on the election night after the result has been announced that Donald Trump has won the election. As we all know now that Donald Trump is a huge crypto fan because he saw that the Chinese are taking over Bitcoin in a massive way. He's constantly pushing Bitcoin hard to make sure it succeeds. He wants every American to own Bitcoin. Of course, any news involving Donald Trump tweeting or talking about Bitcoin, if it is a positive news, the Bitcoin will pump. And if it's a bad news, Bitcoin will dump. This characterizes that traders and investors are now rushing into Bitcoin. So this huge bullish candle carries post-catalyst context. It influenced the mind of traders, even the retail traders, especially on perception about Bitcoin post-announcement. So you as a smart trader, what are you going to do? I've already taught you how to trade support and resistance. Always avoid the price, all the action that is happening inside the support and resistance areas. You should always avoid them. Whenever you try to trade inside here, you're going to hit a lot of stop losses. How do you trade it? You wait until you see a candle breaking out of that, either the support or resistance. So in this scenario, where do we have our breakout? We had our breakout on the resistance area with this bullish candle. How do you now trade it? You wait for a retest. But in this very case, the buyers and sellers are dedicated to this price movement because of Donald Trump. He is a Bitcoin president. We now have a Bitcoin president in the United States of America. So most people will not wait for a retest of that resistance as it broke. When the resistance broke, some people will not be waiting for a retest. What will they do? They will ride on with the price immediately. Immediately they saw this bullish candle breaking out of that resistance area, they put their entry and put their stop loss below this swing low. Some can target 4 risk to reward ratio, some can target 2 risk to reward ratio. So this is how to trade the support and resistance whenever you see them. Always avoid trading within the range. The most crucial area where you can take your entries is when we are breaking out of the resistance zone or when we are breaking out of the support zone. The third contest is trends. We have the uptrend, we have the downtrend, we have the sideways market. This is the downtrend, this is the uptrend, and this is the sideways market. So in order for me to draw it clearly, this is it. So I have to delete the middle line. So we have the downtrend, this is the uptrend. So for the sideways market, I always like to use bar instead of line in drawing my sideways market. You can also call it a ranging market. During an uptrend, price usually overwhelms the sellers. As you can see, price is constantly doing what? Pushing up, meaning that the buyers strips the sellers of their strength and they took control. So when you see dominant consecutive green candles forming in an uptrend, it signals to you that it is a continuation to that uptrend. So what are consecutive green candles? Consecutive candles are candles that form together without any interruption from the sellers. This is the first large green candle, this is the second large green candle. As you can see, both of them, they form together without the red candle coming in between them. This is a signal that this is a strong bullish movement to the upside. So it's an uptrend. So whenever you are seeing them, you will see larger bullish candles than red candles. The red candles that will appear in an uptrend are going to be smaller than the green candles. Even if you have small dojis or small red candles, they are just a minor pullbacks. This small candle here is what we call the doji. This is another doji candle there. So even if we have small doji candles forming in an uptrend, they are just signaling to us, you see, that it is a minor pullback. We are not retracing deeper. So as you can see what happened there, price was trending up. As it trended up, it reached here, there were formation of dojis. At some point, a doji formed again, and at some point, small candles start forming. This is just a minor pullback. It's not going to pull back directly like this because we are having larger bullish candles than the red candles. I just want you to pay attention to whenever we have large bullish candles in an uptrend, this should boost your confidence to trust your setup the more and continue riding with the price to the upside. Do you understand? So this is just how to know when to trust your setup in a bullish uptrend. Until we have what? A large rejection candle just towards the end of that uptrend. Or we have multiple red candles forming together. This should signal to us that we are about having a reversal or a pullback. So as you can see, what happened right at the end of that uptrend? What exactly happened? We have this large candle formed. This large candle formed and followed by consecutive red candles. This should signal to us that we are about having what? A pullback. So this pullback is going to be more significant than this kind of pullback. This is a minor pullback, but this is a major pullback. Pay attention to this. This is a minor pullback, and this is what? A major pullback. So whenever we see large red candle forming at the end of that uptrend, this will signal to us that we are about having what? A reversal or a pullback. This also applies to the downtrend. In a downtrend, what are we going to be seeing? You'll be seeing this is opposite of an uptrend. That is for a downtrend. Remember, we were seeing a large bullish candle, large green candle forming in an uptrend. But in a downtrend, we'll be seeing what? Large red candles. Just try and spot the difference. This is a context. This is what is going to give you a sign that what you should trust your bearish setup the more. So even if we are seeing small dojis will appear in an uptrend, dojis will appear in a downtrend too. So you will see dojis there. Whenever you see dojis is a signal that we are just having a minor what? Pullback. Even if you see small consecutive green candles, it is just what? A pullback too. The only time we'll be concerned, we'll be very careful, is when we are getting to the end of the downtrend. We'll be seeing larger green candles forming. This larger green candles forming towards this downtrend is signaling to us that we are about having what? Reversal. What type of candle pattern formed here? This is what? This is a bullish engulfing candle pattern. If you pay attention and remember what I said about the engulfing candle, how does a bullish engulfing candle form? We have a red candle form first, followed by a green candle that took control of it completely. So yeah, this green candle engulfed this red candle completely. So when this happens, we have a bullish engulfing candle. Towards the end of a downtrend, when you see a formation of a bullish engulfing candle, you're not only going to see the engulfing candle. You might see the morning star forming here. You might see the bullish Herami forming here. You might see the bullish engulfing candle forming at the end of that downtrend. You might see a morning star forming there. You might also see 3 white soldiers forming. So whenever you see this forming, this is a signal that we are about having a reversal to that downtrend. Where can you take your entry on the bullish engulfing candle? At the close of the bullish candle of that bullish engulfing pattern. That's where you're going to take your entry. So let's go back. If you want to take your entry from this engulfing candle, where exactly? Of course, it's going to be at the closing price of the bullish candle. Put your stop loss below the low of the green candle, then target 3 hours. So if you were to see a bullish reversal candles at the end of the downtrend, that's where we will pause to make a decision. Interpret fast what type of candle is being printed right there. So the type of candle that is being printed here is an engulfing candle. So in the sideways market, this is called a ranging market. This can also be called a base. The upside can be called a rally. Then the downside can be called a drop. It can also be called a rally to the downside. So the range is called a base. You must have come across traders talking about base, drop base, then rally base rally, rally base drop, drop base rally. These are the scenarios where you will see a rally first, you see a rally, then you see a base. At the end of the base, you see a drop. So this is called a rally base what? Drop. In another scenario, you can see a drop base rally. There are different types. You can also see we have also drop base drop. And we also have a rally base rally. These are very, very lucrative and informative content that I'm giving you all for free. If you've not subscribed to this channel, subscribe to this channel and like this video, because you hardly see this kind of content somewhere else. So the base of every price action can be seen as an order block. All those can be seen as what? An order block. Bases are ranging price action. It's also a sideways, as you can see, as price is ranging there. So that's a cluster of orders. That's a bunch of orders sitting there. So immediately we have a push up to the upside or a push down to the downside. That range, that consolidation area can be taken as what? An order block. So, but I'm going to go in depth of all this so that you can understand perfectly. I'm not going to go in depth for the sake of this video, because I don't have much time left again to teach you the remaining part of the topics. So all this can be, so whenever you see a base can be seen as an order block, consolidation area, or ranging areas. Whenever you see price move immediately out of that base, so the retest of that base can be seen as what? An order block. That's where you can take your entry and write down the price. The same with other formations. So this is what? This is drop base drop, This is rally base drop. Then this is rally base rally, drop base rally. Take down notes or even a screenshot. So we have a sideways market. In the sideways market, as I already told you, sideways market can be seen as a range or a base. So it is a ranging market that occurs where buying and selling are balanced, causing price to move within a range. So price is neither moving up fast, moving fast. So when you see price in this range, generally we see indecision candles. We always see indecision candles in this kind of price actions. So these are indecision. I've already mentioned, you can see indecision candle. I've already mentioned that you can see indecision candle in an uptrend or a downtrend. You can also see them in a ranging market, sideways market. So these are indecision candles. When price is in this range, generally we see indecision candles and even some of the large body candles. Yes, you can see large body candle. This is a large red body candle. These are consecutive red candles. You can see green candles too, large green candle bodies. So whenever you see them, some of these large body candles that happen within this range, they don't have the same meaning. Pay attention to what I'm about to tell you. All the large body candle, whether green or red candle bodies that are forming, as you can see, all these large candle bodies, they form within this range, within the confines of this range, the support and the resistance. They don't have significance like the one that happen out of the range. This is large body candle, that the two large body candles that happened out of the range. These two large body candles, they don't have significance. Pay attention. Even some of the large body candles that happen within this range don't have the same meaning like they happen fast in a fast price movement, or because they are stuck. This green candle, large green candle that broke out of this range, and the red and the green candle that is happening inside this range, they don't have the same meaning. The ones that are happening inside the ranging market, they are trapped in this range. But the ones that are happening out of the range, they are breakouts. So breakouts happening out of the range are large candle bodies. As you can see, you always find large candle. You cannot see a doji candle forming out of a range. The only candle that you can see there is a large candle body. What is this signaling to us? It is signaling to us that liquidity has been injected in the market. So that is when they carry great significance. Then context is very important here. The context, the meaning it has out of the range and the meaning it has within the range are not the same. Context is very important. Do not have confidence in large candle bodies that are happening inside the range. The one that you can have confidence in is the one happening out of the range. Note these two differences. Then how can you take an entry? Immediately the large candle body broke out of the range. Then that's resistance. This resistance return to what? A support. This is where you can take your entry. Put your stop loss below this swing low. When we get to 1 risk to reward ratio, you can take your partials. When we get to 2 RR, you can take your full take profit or break even. So even if the market stopped you out, of course you've already taken some partials. So this is how you can be trading ranging market. Ranging market is just like trading support and resistance areas. So on the next segment, I'm going to talk about the individual and the multi candles. Doji is a one individual candle. So in a doji candle, price pushed up and down shows neither the buyers or sellers have complete control during this particular time frame. So when we talk about the use of dojis, and where they are most effective at, you will always find them at a ranging market, just like I mentioned to you. So this is the bullish version of a doji candle. This is the bearish version of a doji candle. Where can you always find dojis? You can find dojis at what? The ranging market. This is a doji candle. You can always find them always and always at what? At a ranging market. So all these are dojis getting formed here. So that's why you can always find doji candles. Another type of one individual candle is called the marubozu candle. This is a momentum candle. You can also call it a momentum candle. They often communicate complete control on one side of the market or the other. So in the context of any market, you see this type of momentum candle. They also communicate what? Continuation. You can see what happened on the uptrend and downtrend. You can see what happened on the downtrend here. Even on the uptrend, when we are having an uptrend, this is what? This candle is what? This candle is a marubozu candle, a momentum candle. They communicate continuation. That's what they always do, what? Communicate. Another type of individual candle is the hammer or pin bar. It shows that the buyers regained control both on the bullish version and the bearish version. It means that there was an initial sell-off from the sellers, then the buyers regained control. So at any position you see this kind of candle form, either the bullish or the bearish candle, pause and pay attention to what the next candle that will form to it will do. So anytime you see a hammer pin bar form, do not take an entry immediately. Pause and wait for what the next candle that will print close to it will do. I'll show you an example just now. So they usually have strong significance on the price. The opposite of the pin bar or the hammer candle is the inverted hammer. The inverted hammer is the opposite of the pin bar. So there is a strong bias at the initial stage. There was a strong buy from the buyers, strong push up from the buyers. That at this point, buyers got exhausted, so sellers have to take control and close the candle bullish. The same thing happened on the bearish version, but at this time they close it bearish. This is called the inverted hammer, where the inverted hammer and the pin bar form is very, very important. You have to pay attention to what he's doing. Any candle that will print close to it, that's where you pay attention to. Whenever you see an inverted hammer forming, do not trade it immediately. Wait till you see what the next candle that will print close to it will do. Let me show you an example. Let me show you an example here. When this type of candle shows up in an uptrend, this is an uptrend. When this shows up, when the price is moving upwards, the inverted hammer can signify a potential reversal, whether the bullish or the bearish version. Let me show you an example on the chart to see how an inverted hammer causes a reversal. This is an inverted hammer. So immediately you see this inverted hammer, price moves down fast to the downward direction. What does it mean? It means sellers were able to regain control. At the initial stage, buyers pushed the price up. Then sellers took control and closed the candle bearish. Now we have what? We have we formed an inverted hammer candle. What does it mean here? It means a potential reversal. Do not do anything yet. Wait for the next candle, what the next candle will do, and how it's going to close. So at the end of the day, the next candle closed bearish. How can you take advantage of this market? Take your entry right at the second candle where it closed, at the closing price of the red candle where it closed, and put your stop loss where? Put your stop loss above the high of the inverted hammer candle. Remember, Do not trade them alone. Do not trade them alone. As you can see here, it manipulated a high. It swept the previous high plus a bearish fair value gap that formed there. Those two are the confluences that enabled the sellers to do what? To sell this price way lower. This is another context. Whenever you see a bearish inverted hammer, just know that it is signaling to us that there will be a potential reversal to the price. And do not trade them alone. Always look out for other confluences. As you can see here, there was a previous high. It swept a previous high plus a bearish what? Fair value gap. Those two were the two confluences that happened at this area. The more confluences you have at a particular area or at a particular zone, the stronger your entry, the stronger the bearish price movement will be. As you can see, there was a strong push to the downside, even up to 5 risk to reward ratio. So this is always how you can take advantage of the market using an inverted hammer. There are other individual candles too. The same thing can happen when you see a hammer. This previous example was an inverted hammer. So this example also can happen with a hammer or a pin bar. So whenever you see a pin bar towards the end of a downtrend, towards what? The end of a downtrend. Remember, an inverted hammer was towards the end of an uptrend. So a hammer or a pin bar is towards the end of a downtrend. So whenever you see it at the end of a downtrend, it means a potential reversal to the upside. So as you can see here, whenever you see it, wait for it to close first. Then wait for the next candle, what the next candle wanted to do. And remember, context is what? Very, very important. Context is very, very important. You'll be checking, was there another block that formed there? Of course, there was another block that formed there. This is another block. It rested on top of what? Another block, showing to you that it has what? A confluence. If it forms without a confluence, without it resting on top of a confluence, another block, fair value gap, or a support, remember, you cannot trade them alone. Always add confluences to it. When you add confluences to it, the more confluences around a pin bar or a hammer candle, the more confluences you have around it, the stronger the movement will be. As you can see, it rested on top of a what? 1 day order block, demand zone. So how can you trade it? You wait for it to close completely. So as soon as it closed, the other candle that formed, wait for it to close. At the closure of the second candle, that's where you're going to put your entry. Then put your stop loss right below the low of the other block or below the low of the pin bar, and ride up with the price. This is how to trade it in the market. If you master individual candles, these candlestick patterns, and add them to your trading model or strategies, you can never be lost in the market. Another type of candle that is similar to the hammer or the pin bar and even the inverted hammer are the dragonfly doji or the gravestone doji. So their long wick communicates an even strong amount of rejection. As you can see what happened. So we have a strong rejection there. At the initial stage, buyers did what? Push the price lower. So before the day ends, sellers took control. The same thing happened with the bearish version. Whenever you see this type of candles, they communicate generally that price is going to move in the direction of the candle body. Price is going to move where? In the direction of the candle body. Whenever it closes, always be watchful for the type of wick they usually form. Their wick is different from the wick of the hammer candle or the inverted hammer candle, and the price always follows the direction of the candle body. Let me show you an example on the chart. This is an example of what? Of a dragonfly doji. So this is an example of a what? Dragonfly doji. Look at the wick and the body. The wick is way longer than the body. So the length of the wick and the length of the body are not the same, and price always move in the direction of the candle body. As you can see here, price move in their direction because it closed what bullish. So if it closed bearish, remember it's going to be at the end of, always look out for it at the end of an uptrend or at the end of a downtrend. So as you can see, what actually happened there, price was pushing down, then towards the end of the downtrend we formed what, a bullish dragonfly doji. What the price did next, price went in its direction. So let me look out for the bearish version. Yeah, this is it right here. The wick is always larger than the body, so the wick is way longer. So as you can see here, you can't call this an inverted hammer. This is a gravestone doji, the bearish version of this type of candle, gravestone doji candle. So price moved in the direction of the candle body where it closed. So the candle body here is bearish. Remember you can't trade it here alone. It manipulated the high. This is the high it manipulated, and price moved in its direction. How can you trade it? Trade it when the candle body is closing. So right at the closing price of the candle body, that's where you can take advantage of this type of candle. Then write down with the words, with the price, and write down with the price. So you shouldn't be greedy. Here. You can first of all take your partials at 2 risk to reward ratio, then bring your stop loss to break even, where you can be safe. Maybe if the price is trying to reverse, you can be safe because you've already taken some partials out of the market. So this is how to take advantage of what the dragonfly do. This is a one individual candle. Another type of candle, the tweezer top and the tweezer bottom. So this is one type of a tweezer bottom. This is another type of a tweezer bottom. So in this type of tweezer bottom, the wick can be different. Then one of the wick can be larger, but the body, always pay attention, the body will always be at equal levels. The same with this one. This is a tweezer bottom, and you can always find the tweezer bottom at the end of a downtrend. That's where you can always find what, a tweezer bottom, right towards the end of what, a downtrend. That's where you can find what, a tweezer bottom. So both of the tweezer bottom, these types of tweezer bottom, you can always find them towards the end of a downtrend. So that's where you can find them. So these two type of candle patterns communicate rejection. So if you are in a downtrend and you have a large bearish candle body which is consumed by another equal large bullish candle, both the tweezer candle make almost equal candle body, both the bearish and the bullish one. This can possibly indicate a reversal at a critical level. So the bullish tweezer bottom will always be seen at the support level. Always look out for it at the support level, or add other confluences like the order block or the fair value gap or support levels. That's where you can always trade it, and it will have significance to your price action. Add confluences to it. The same thing applies to the tweezer top. Tweezer top, you will always see tweezer tops at the end of an uptrend. That's where you will find what, tweezer top. You always find them at the end of what, an uptrend. So tweezer top will be spotted at the resistance level. Order block can be your resistance, even your fair value gap can be your resistance. Remember, it can't operate all alone on itself to show a strong movement conviction. If you trade them with an order block, fair value gap, or a resistance level, they will have strong movement conviction. It also needs other context like sitting in an order block, as I just mentioned. So these are other contexts that you need: order block, the fair value gap, or another resistance. So none of these types of candle can operate on its own. You have to look out for support, resistance, trend, news catalyst, Yes, whenever if there is a new catalyst, if there is a war news, even NFT, FOMC news, they can also be a news catalyst that can push price lower with the help of these types of Tweezer top candle pattern. So it is good as a beginner to understand what these are and how they function. So you can go ahead to study other candle patterns that I have shown to you and master them like the few examples I have given you. So how can you trade the Tweezer top? So whenever you see it, this is a Tweezer top. So this is what this is an uptrend. Price was trending higher. So in this price leg, it was doing what? Price was trending higher here in this price leg. So when it got to this point, we start forming what? It starts forming what we know as the Tweezer top. You will study this often and on in order for you to master it. How do you take control? And it is going to cause a potential reversal. In order for you to trade it, do not trade it alone. Look out for a resistance. If there's a resistance there, maybe another block or a fair value gap, bearish what? Bearish 1 day fair value gap. This is another confluence you can add to it for you to have a strong movement conviction. Then where can you take your entry? You can take your entry from where? Make an entry from this type of candle pattern. Whenever you see them form, both of them form, the two candle bodies will be equal. They will be equal. So the large bullish candle was consumed by another equal large bearish candle. This is signaling to you that from the close of the red candle, then right down with the price, they can always be spotted on the chart. So for the sake of this video, as I have taken a very long time in making this video, I'm going to stop here. You can go on and study other candle patterns that I have shown to you and master them like the few examples I've given to you here. We have come to the end of the video, guys. Sorry, this is my first teaching about trading information. That is why I took it slowly to teach. You are currently witnessing my second episode of the real candlestick pattern information in the YouTube history. This teaching is not a trading model or a trading strategy. I have my own trading strategy, but this is a concept that you can add to your trading model and strategy for you to have a strong edge in the market. So I have my trading model and strategy, which I will teach in the future videos. But I wanted to take my time to teach you about candlestick patterns because you also need it. So when I'll be mentioning all these concepts in my model or in my strategies, you won't be confused because you've already learned about all these candle patterns. So in the future, many of you will become millionaires through my teaching. So when that happens, don't forget me and always pray for me. The biggest problem why many of you guys stopped out in your trading is because you neglected the power of what candlesticks can do. But after watching this video, if you apply the knowledge well into any trading model you are using, you'll be grateful and proud of yourself. You will all be the best. Don't forget to subscribe, comment, and support me. Remember, your little support can push this video to someone that needs it just like you do. Alright, thank you guys for watching. See you in the next episode.